The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. I'm Debbie Yong. In Singapore, even high net worth individuals are facing a new reality that retirement is getting more expensive, more uncertain, and harder to sustain. Despite high levels of wealth, confidence in retirement preparedness remains limited. An increasing number now expect to prolong their careers beyond retirement age, underscoring the impact of rising costs and financial constraints. And this raises a bigger question. If wealth isn't translating into retirement security, then what's missing? How should high net worth individuals be investing to generate sustainable income, manage risk, and ensure their wealth lasts both through retirement and beyond? To help us unpack this, joining me now is Lionel Lee, money expert at the Better Foundation. Hi, Lionel. Welcome back to the show.
Hi, Debbie. Pleasure to be back on the show with our listeners. Thanks for having me.
Yeah, always great to have you. So, Lionel, recent surveys show that even affluent Singaporeans now estimate needing up to 1.9 million Singapore dollars for a comfortable retirement. And yet, despite this level of wealth, many of them still feel unprepared, and a growing number of them are expecting to work beyond retirement age due to rising living costs and longer lifespans. So, Lionel, could you help us unpack why are even high net worth individuals experiencing the sense of retirement insufficiency despite having quite substantial assets?
Well, I think it's because a lot of the high net worth individuals' portfolios were never designed for income durability. They were designed for wealth accumulation. So the challenge here is that their portfolio doesn't answer that question of, can it pay me consistently for 30 years regardless of market conditions? And when the market conditions are volatile as they are now and also in the past, and again, it will be in the future, it requires a shift in thinking. Again, our ultra high net worth and high net worth individuals are able to make that shift from chasing returns to engineering cash flow resilience.
So, Lionel, how then should high net worth investors rethink and redesign their portfolios as retirement capital requirements continue to rise?
Well, the traditional model, which is 60% equities and 40% bonds, was built for a different era. I think a lot of high net worth individuals, especially our boomer friends, they are familiar with that environment where, it's lower inflation, it's shorter retirements, more predictable markets. Unfortunately, today that model is fragile. So I can't say for everyone. I can say basically for myself, I construct my sustainable retirement portfolio around 4 pillars. So I look at income producing assets, basically dividend paying equities, private credit strategies that generate steady cash flow. The second pillar is to look at inflation protection. So real assets like property, infrastructure, commodities, they adjust with rising prices. The third is having a growth engine. So that means selecting equities and private market investments that ensure that our portfolio continues to compound over time. And the fourth, not the least important, is the liquidity buffer. So having cash or near cash reserves, not just to fund, a couple of months. Most conversations are like funding 6 to 12 months, but I think you need to look at reserves to fund 2 to 5 years of expenses in order to protect against forced selling during downturns.
That's a very sensible way of thinking of the key building blocks, right? So I want to pick up on your point on inflation protection. So as retirement becomes, more flexible these days, right? It's no longer a fixed endpoint. Investors are shifting from accumulation, as you said, to income and income generation and sustainability. So what investment strategies are the most effective for generating durable and inflation-resistant income streams?
I don't know about the most effective strategies. I would say that the strategies that I've used that are effective have 3 characteristics when I actually review those strategies. So the first characteristic is consistency over yield. I believe that a stable, 4 to 6% income stream is more valuable than a volatile 8 to 10%, which is what most Singaporean high net worths tend to focus on. The other thing, it would be diversification of income sources. So, dividends, rental income, private credit, infrastructure, cash flows are important. And also, one of the points I mentioned previously was inflation. So you need assets that can reprice over time, and real estate and infrastructure allows you to do that. So, in summary, income is not a byproduct of investing. For me, it is a primary objective. And that's probably the difference between the portfolios of many high net worth individuals who are struggling to retire, because their primary objective is wealth accumulation and not actually generating enough income to fund retirement comfortably. And we're not talking about 1.9 or more or less, but it's essentially funding for them what they believe is the amount that they need for a comfortable lifestyle post-retirement.
Right. Yeah, I think generating income is a good point there. But at the same time, market volatility remains a key concern, right, for many high net worth investors,
yes,
particularly in retirement when drawdowns can have a lasting impact. So how should high net worth individuals position their portfolios to withstand market volatility during retirement?
Yeah, that's an important point, because all of us, I guess, plan for retirement, and the challenge with market volatility is actually dangerous, because a significant drawdown early in our retirement planning can actually permanently impair our portfolio's ability to recover. So that is a key risk, and it's what I call sequencing risk. The way in which I go about withstanding this kind of volatility is I structure my portfolio with low correlation assets, example alternatives, and then I look at also dynamic withdrawal strategies that allow me to adjust spending during downturns. And importantly is to have, like a kueh lapis, dedicated income layers that reduce reliance on selling your growth assets when it's crunch time.
I like the kueh lapis analogy. That's a very nice visual.
Yeah, Singapore audience, right? So I have to talk a bit about kueh lapis, right?
Yeah. So, speaking of diversification, what role does diversification and alternative assets play in managing downside risk?
I think with a lot of the high net worth individuals who are like millennials and the Gen X, they realize that diversification today goes far beyond stocks and bonds. So a lot of the conversations around alternative assets, as you mentioned, private equity, private credit, hedge strategies, infrastructure, essentially all of these play a role in reducing overall portfolio volatility. They provide a stable contract-based income stream or streams, and they also enhance returns without increasing public market exposure.
Yeah, but earlier this week, we had conversations around very alternative assets like the $66 million dinosaur bones. Do you think, those very alternative assets actually increase your risk as well, because they're hard to value, they're hard to, pass down, they're hard to observe?
I think there are alternatives and there are alternatives. I wouldn't go down the road of dinosaur bones. I would stick to alternative assets that as an individual you can understand and that you can make sense of, and not basically dabble in stuff that I guess is beyond your ability to reason and to also be able to see and assess the risk. So always do what you are able to understand, or at least what you can learn to understand.
That's a very logical point. So speaking of alternatives, is there, on the flip side, is there still value in the tried and tested? Are traditional portfolio models still sufficient for a 25 to 30-year retirement horizon?
In short, no, because one of the points that we mentioned earlier in the conversation, right, is that the traditional portfolio model is, I won't say it's defunct, but it is in the face of the challenges that we're facing. So it's static basically, and it fails to account for the prolonged inflation cycles, structural market shifts, and the need for adaptive income strategies, which is the area that most of our high net worth individuals fail to plan for, which is why retirement becomes such a challenge. The important point to remember is that retirement investing or investing for retirement is dynamic. It's not static.
That's a good point. Retirement is also a longer process these days. So how can investors mitigate sequencing risk, especially, say, in the earlier years of this retirement period?
That's a challenge that I faced as well. I was also thinking about it, for myself when I was looking at retirement. And the way in which I approach sequencing risk is to use basically what I call buckets. So I have 3 buckets. So bucket number 1, 0 to 5 years, I look at cash and low risk assets for immediate income. Bucket 2, which is 5 to 15 years, I look at income generating investment. And bucket 3, which is 15 years and more, I look at growth assets. So this structure basically allows me and any other retiree to avoid selling long-term assets during market downturns and also preserve the compounding. So so that's just a simple approach that I took.
I see.
And I still use today.
And at the same time, I know, many high net worth individuals, particularly in Asia, have to balance their own retirement needs with the desire to preserve wealth for the next generation. So how should such investors balance retirement income needs, as you have been emphasizing, with intergenerational wealth transfer goals?
I actually wrote an article for Business Times that was on this particular topic. For our listeners on radio, in summary, yes, many high net worth individuals are not just planning for retirement, they are planning for legacy. But this actually creates a tension because I think a lot of them are thinking, how do I spend confidently while preserving wealth for my next generation? So the approach that I look at is borrowed from marketing, and it's called segmentation. Essentially, I segment the portfolio, number one, by allocating a portion of assets specifically for retirement income. Then I ring fence the long-term growth capital for wealth transfer, and then use structures, such as trusts and even some advanced insurance solutions to actually enhance the efficiency. So the focus here is that not all capital should serve the same role. And so you have to be clear in terms of the purpose of your capital.
And how would you split the balance between these three priorities, or does that vary according to the individual?
It's hard to provide a formula, and I think it really depends on the individual based on, number one, how much retirement income they feel they need. Some people need a small amount, some people need a much larger amount. And so I think that is something they need to decide. Once they decide how much retirement income they need, then it's easier to allocate a portion of the assets. That then tells you how much percentage is also available for wealth transfer. I mean, at this point, not being selfish or not so concerned about the next generation, but I think that the current generation, that means the current wealth owners, should be thinking about themselves first in terms of how much is available for their retirement and for them to enjoy the retirement, and then look at what else is available to actually share with the next generation, especially if the the total amount or total net worth is limited. So if you don't have $300 million to spread around, you only have basically a high net worth individual, maybe somewhere between $5 to $29 million to spread around over a long period of time. We talk about 20 to 30 years.
Okay. Lionel, with a final question before we let you go. We've spoken about priorities, but if you had to redesign a retirement strategy today, what is the one risk that ultra high net worth or high net worth individuals may be underestimating?
I think the one risk is what we touched on earlier, but just to summarize that risk, is longevity paired with inflation, because our folks are living longer and inflation is a constant. So, I mean, individually, they are manageable, but together they are actually quite devastating, and people don't realize the impact. And also, one of the thoughts to leave with our listeners is this, that retirement is not about stopping work. It's about achieving financial independence with options. So if your portfolio today cannot clearly answer the question of how will this pay me for the next 30 years, which is a point that I raised in our earlier part of the conversation, then it is time to actually rethink your retirement strategy and plan.
That is a very good reminder. Yeah, thank you, Lionel, for joining us today. I really enjoyed this
My pleasure.
chat, especially your very visual analogies from buckets to kueh lapis.
Yes, it's difficult. It's difficult to have a chat over radio, right? Because we're only audio, so help our listeners to visualize.
Yes, I really, really enjoyed that. So thank you for joining us. Yes. That was Lionel Lee, money expert at the Better Foundation. And this has been the Wealth Tracker with me, Debbie Yong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
To listen to more great interviews, download our podcasts at moneyfm893.sg